In the previous video, I talked about the various forms of fundamental funding that companies can use to fund growth. And I talked about internal funding, debt funding, and equity funding. I briefly mentioned there's a fourth form of funding, hybrid form of funding called convertible debt or convertible note, which I want to talk about in a little more detail now and also compare to equity funding. So convertible note is a debt instrument that converts into equity under pre-agreed conditions between the investor and the entrepreneur. Typical convertible notes have several features. They will have a obviously face amount, which is the amount of money in the note. They will have a maturity date, which is when the note either needs to be paid back or will convert into equity. They'll have a coupon, which is an interest rate that is paid on the note, but is typically accrued rather than actually paid to the investor. They'll have a discount to the next round valuation, and they may or may not have a valuation cap. How the typical convertible note works, the company, instead of issuing equity when they get cash from an investor, they give this investor a convertible note. Let's say that the investor put in $500,000 in a convertible note with a 10% coupon and a 1-year maturity and a 20% discount to the next round valuation, and trigger conditions, which mean that equity conversion of the note to equity will be forced if the company, for example, in this case, raises further $1 million at any time in the next 12 months before the note matures. So let's look at how that would work. If the company raises $1 million at a $10 million valuation within the next 12 months after the note is issued, then the $500,000 plus the accrued interest. Imagine it happened sort of exactly 1 year. So 10% interest, $50,000. So $550,000 would convert into equity at an $8 million valuation, which is 80% of the valuation in the next round. If the company failed to raise $1 million or failed to raise $1 million within the 12-month period, the note would mature, at which point the company would have lost the ability to force conversion of the note. The note will stay outstanding as debt and now is straight debt rather than convertible debt. Why might entrepreneurs or investors want to do convertible notes versus equity? Investors may want to do convertible notes rather than equity because until the note matures, or if the note matures without the company effectively forcing conversion, then the investor is a lender rather than equity holder. Lenders have priority in the liquidation of the company, even over preference shareholders. So if the company fails while the note is still outstanding, that lender stands a better chance of getting their money back than they would if they were an equity investor. In addition, if the note doesn't convert, the note holder would then continue to get paid interest based on the coupon of the note. So this actually puts the investor in a note in a relatively favorable position to that same investor making an equity investment in the company, which tells you why investors might prefer convertible notes. For the entrepreneur, why might they prefer a convertible note? Typically, because the note converts at a discount to the next round valuation, in almost every case, the company will give up less equity with a convertible note than they would have given up with an equity investment done at the same time as the note. Looking at the sample case that I mentioned earlier, that investor putting in $500,000 today, maybe they wanted, looking at something like a 2.5 million valuation for that $500,000, so they get 20% today. If the company is willing to do that in the form of a note with a discount, remember that that investor later, if the company was successful, converted that investment at 8 million instead of 2.5 million, and that's a big difference. in the amount of equity given up by the company. So a lot of entrepreneurs focus on that aspect of convertible notes and get a little bit blinded to the downside. So what's the downside of convertible notes for the entrepreneur? It's true that if the startup does force conversion before the note matures, then they can, in many cases, do a lot better in terms of equity given up than if they had done a straight equity deal. If they fail to force conversion, which happens a lot more frequently than entrepreneurs might realize, then they have actually just taken straight debt. Remember my view on straight debt, you can go back and watch the video on different forms of funding and why equity funding is vastly preferable to straight debt. In this case, the convertible note that failed to force convert has become, in many cases, straight debt, and entrepreneurs now have the same problems with this note that they would have had if they had taken straight debt. This is a hidden cost of the convertible note, or maybe not so hidden, but this is the cost of the convertible note that a lot of entrepreneurs don't pay as much attention to as I believe that they should. Another feature of convertible notes is cap. So some convertible notes have a cap or valuation cap, which puts a ceiling on how high of a valuation the investor will convert at. For example, in the convertible note example I used previously, let's say that note had a 20% discount and a $5 million cap. So in that case, when the company converted at the next round valuation of 10 million, the investor would convert at 5 million instead of 8 million because the cap puts a ceiling on the valuation at which the investor can convert. Investors will convert at the lesser of the cap or the discount valuation. Why might investors want that? Obviously because if the company is super successful and the next round valuation is really high, then the investor might get a very small equity portion. Why might the entrepreneur be willing to accept a cap? Because an investor doing a convertible note instead of an equity investment should be willing to give a higher valuation cap than they are willing to give a valuation for a straight equity investment at the same time. Why should that be the case? Because the valuation cap only comes into effect once the company has exceeded the valuation cap in the next round of funding and by at least the discount rate. So that means that the hesitation that the investor had to giving that valuation in a straight equity investment implied that they didn't believe that the company would be able to significantly exceed that valuation in the next round, and in a cap convertible note they definitely would have done that. That's how caps work in convertible notes. I would be very cautious as an entrepreneur, or I advise entrepreneurs to be very cautious taking convertible notes. One way to look at it is, as an investor, I actually quite happy to do a convertible note, and I think a lot of investors are happy to do convertible notes, which should tell you something. It should tell you that if investors are more comfortable with convertible notes than straight equity, entrepreneurs should be less comfortable with convertible notes than they are with straight equity, because it's not, win-win for investor and entrepreneur. I believe the convertible note is tilted toward investors, and therefore entrepreneurs should be cautious. There is another class of convertible investment instruments that are called safes and safe-like instruments, which are equity convertible instruments that don't have some of the downsides of convertible notes. I'll talk about safes and other safe-like instruments in another video. Summarizing, for a convertible note, they might be useful under some circumstance, but in most cases I still recommend startups focus on straight equity investment rather than convertible notes.